bro? What's up, bro? Hey, dap me up, dap me up. Yeah. Hey guys, welcome back to the After Hours. I'm the eight-tailed beast, and today we're gonna talk about bank turmoil. We've brought this up many times. We're in a banking crisis. And if you look at the headlines, that bank crisis has stopped at least 2 times. And that's come from a lot of help from the government, mostly from funding programs that injected liquidity into the financial system. And that supposedly solved the problem. Well, a lot of people still believe that the problem is systemic. This fear that's slowly spreading through, that we call a contagion, that is still inside of everyone. And we can see that when there is a rally, more of a meme rally inside of the bank stocks. This is especially the case for the lower banks that have less than $100 billion. We're talking about regional banks and below. The larger banks, they have enough cash on hand, enough liquidity to handle most problems that come up, or at least suppress any fears that their investors and depositors may have. Now, we've had several reasons to be worried. We're talking about SVB, FRC, and a whole lot more. But this week, we're gonna focus on PACW, West Bank, and some other regional bank. The overall system right now, it does have more liquidity, but the environment that we're in, it's not suitable for you to borrow. When you look at a bank, normally you think strong. You think a lot of money is there. That's true. When it comes to the bank, it's a company. Companies have strong fundamentals, and those fundamentals give you an idea of what the future looks like. When you look at the market is a tool. It's a device to transfer money, and it transfers money from investors to the company. Now, the device that we use is the stock market. The stock market itself is just a lot of companies connected to each other, either online or through paperwork. Now, when it comes to the stock market and being a citizen from the stock market, you can make this as complicated as you want. But banks, they're the common device that everyone uses. Now, depositing is a thing that everyone does because you have to have somewhere to put your savings. Those savings usually make money for you, and that's because the bank gives you a percentage. Now, when we talk about getting paid to save money, you have to let your money sit long enough for it to accumulate interest. And when it comes to the banks right now, that interest that they get that brings in larger customers, that is the foundation of their fundamentals in their company, or at least a part of it, a large part of it, their payout is too small for this environment that we're in. The environment we're in right now has really high interest rates, especially after last week when we raised the rate hike by another quarter point. Now we're sitting at 5.25%. So before, when we talked about the banking crisis, we focused on insured versus uninsured. It only takes half of the uninsured deposits inside of a bank before it fails, according to Investopedia. Well, when people see fundamentals are changed, that's not looking good for the long term, which means those big players, they're getting outside of the market. They're getting outside of the bank. And where they're gonna go is to the larger banks like JP Morgan Chase, which is #1 right now. When it comes to this week specifically, we have PACW and Western Bank, CRE, and other smaller banks that have under $100 billion in market cap and a lot less cash on hand. Now, the main problem with these smaller banks is there is commercial real estate loans. A lot of these commercial real estate loans, they are bought by smaller banks. Over 60% of the commercial real estate loans in America are owned by banks with less than $100 billion. Now, this statistic is important because since we're in a high interest rate environment, those loans and paying the interest on those loans, it makes the unrealized losses to the bank higher. And that causes fear because it's fundamentally messing with the banks. It's creating insolvency for a lot of these banks. It's not a realized loss yet, but the shock is enough to cripple the bank. The ones feeling this the most are the mid-size and small banks. PACW is the one that's feeling the most shock right now. Just a few weeks back, we've seen PACW lose over 80% of its share value inside of the stock market. Now, the reason this happened is because of the fear that spread from other banks of similar sizes. Now, it escalated once we actually got the real results from the last earnings report. Now, when the Q1 earning reports came out, PAC dropped 40% in a day, and it continued to do that all the way down to $2. It spiked But the reason it spiked, it was actually not because of a rally this time. It was because JP Morgan Chase, US regulators, and everyone started a rumor. The rumor was they're going to ban short selling. I feel offended. When it comes to banning short selling, I don't think they're gonna go that far. But the rumor itself caused a short squeeze. And when it comes to these banks, they have strong fundamentals. It takes a lot of people, a lot of money to move these stocks 50% a day, 20% a day. So this caused a squeeze, but overall the problem is still there. Now, a little bit more on the big players and the small players inside of the stock market. When it comes to the big players, they are the investors. They are the long-term traders. They're in there for months to years. Those big players, they come in at very low prices. The reason they can get these low prices is because the stock market is a pendulum. It swings from over-optimism to where you sell to that over-optimistic person, and then it swings back to the overly pessimistic, and you buy from the overly pessimistic. Both of them think they get a deal. Everyone in the market that thinks they're smart, they always think they're getting a deal. If you do your due diligence, you might find your truth actually is profitable. But most people don't end up that way, at least as fast as they want. If you look at Warren Buffett's quote, the stock market is a tool to transfer the wealth from impatient money to patient money. That's kind of what he's talking about. But you can get good at it, AKA day trading and short trading. If you want to know more about that, look in the description below. Another thing, when it comes to these stocks that start long rallies, the thing that's propping up the stock is the large players. Now, these large players, once they get out, whether they're on the long side or the short side, the foundation of the stock and its activity is going to drop. There has to be a minimum amount of large players to keep the game going. Now, there's been a lot of activity in the past few weeks. It could be because of the increasing anxiety from where are the interest rates going? Are they going to stop? Is this next one just the start of the next 10? We don't know yet. We just know that eggs are really expensive right now. The market condition is still unstable, and a lot of people are still kind of confused. Bad news is good news. Good news is even great news. The market is really high right now in multiple ways. We've been touching like 415 plus way too many times. I'm kind of convinced we're gonna go back to 450 at this point, because that's the only way this ends, with a melt up before the inevitable meltdown. Now, banks, they have value to a lot of people, especially powerful people. Those financial institutions, they're powerful people's children. You don't mess with their children, they're precious. In other news, let's talk about what happened in crypto. So in crypto, someone had a monkey token and they injected it inside of the cryptocurrency exchange. Now, when they injected 11,000 monkey tokens, it caused a spike inside of the fees for normal cryptocurrency exchange. It went from $1 fee up to $20 fees. Now, the person that benefits inside of this whole plan, this joke, we know it's the brokers. But remember, this blockchain technology, it's a little complicated for a lot of people, and I'm not very familiar with it. But this slow in data and this spike in fees, there's a good chance that someone's out there just trolling and it just went further than they thought it would. I just thought that was kind of funny that anyone could just make their own token. It was an NFT. Now, they made an NFT of a monkey and then they put it as a token. They uploaded that onto the blockchain technology and then it started to gain popularity. A lot of people wanted monkey tokens for some reason. Well, Dogecoin and other cryptocurrencies, they all fall into the same boat. But this particular one, it just clogged up a lot of activity for that day. It caused a few problems, mostly because of the fees. But the chaos that it caused brought attention to the cryptocurrency itself. So nothing's actually happening with like Bitcoin and other cryptocurrencies. They just had a wave of people just come in because of this joke. I just thought I'd throw that one out there. There's a lot of stuff going on this week. The increase in traffic clogged the demand when it comes to the miners of cryptocurrencies. There was too much traffic. It clogged the flow. Now, we don't know who uploaded NFTs of monkeys, but I think it was pretty funny. It was congested. It brought attention. I wonder what's next. Is it gonna be a gorilla? A cat? I want a dragon. Give me a dragon.
I want a dragon.
Dragon Ball. So when we talk about PACW, we know this is Pacific Western Bank. They just lost 10% or almost 10% of their deposits. Now this came after the sale, but it also came after the report showed their balance sheet. They did beat everyone when it came to Q1 earnings, but that wasn't enough to create security. Normally, you would see a sell-off when there is a unsuspected flight in deposits. PACW didn't do that. What they did do is they borrowed money, and who they did borrow from was the FTFP. Now, this is the Federal Reserve. They also borrowed money from the federal home loans. Now, that 10% drop, they covered it with $10 billion. That should be really reassuring for the bank. However, the money that they borrowed from on credit is expensive. They're claiming to have money after touching the second to last reserve money from the Federal Reserve, which kind of gives mixed messages to people. When it comes to the big players, they're easily spooked because they understand that they're going to let their money sit and it's going to accumulate. We're talking compound interest, not just simple interest, but compound interest. Before, this used to be a deal when the environment wasn't as hectic, but now there's more options. There's several incentives for the big players to leave the bank and find a better deal somewhere else, someone that's more secure, most likely a larger financial institution like JP Morgan Chase. And this is the biggest topic right now when it comes to bank stocks. A lot of people don't want to talk about it because if they have a large following, that bad news and mudslinging is going to follow their brand. But the thing that comes out with PACW, they're following everything like they should. But the whole system is kind of a transfer. As soon as they touched that money, they admitted that they needed money, and that money is expensive. So the way I like to see it, they're claiming that, hey, I have money because I have a large credit card limit. But what they don't realize is they have to pay that back at some point. And the whole reason they're in this situation is because most of those regional banks and smaller banks, they own 60% of the commercial real estate. So all those loans that are becoming higher unrealized profits because of the high interest rate environment, it's putting a higher unrealized loss on them. So when it comes to the PACW, they're not selling assets and they're talking about potential sale. So that's a red flag. You got another red flag when they touch the borrowed money. Now, the third red flag, that was headlines and influencers and other things like that. They really couldn't do much about it. However, it just doesn't look good for them in the next month. They're either going to be sold or they're going to lose a lot of money. So it looks inevitable. Now, don't trust me. Do your own research. Okay, so the way PACW is leveraging their access to the federal loans as well as the cash they have on hand is they use the borrowed money to cover those deposits, as they should. But what's happening is they're marketing it as we have plenty of money. We have $15 billion left minimum to cover more deposits escaping. Please calm down. This is unique when it comes to the reaction to having unrealized losses on the balance sheet. Most people would just sell off some of the stuff on the balance sheet. You cut off the poison part of the body. Remember, we're talking about babies. These babies, they're being judged by the world, and people still see the poison, the slow death. Instead, they chose to put a band-aid on the problem when it's a wound. So we're not gonna go any further in that. This thing is a chain effect. Once there's one mistake and then evidence starts to pile up, it doesn't matter how strong the fundamentals of the company are. Even if it's a bank, it's inevitably starting that downtrend until it's going to be bought for cheap after the Federal Reserve picks it up or a larger bank says, let us bail you out. Well, that's all I have for you today. If you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.